Hey, welcome back. Nowadays, a majority of dividend stocks are affected by the Fed's decisions regarding interest rates, and we can see many of them down 30, 40, or even more than 50%. However, Vici, a real estate investment trust specialized in casino and hospitality real estate, is not one of them. With the exception of 2020, since the IPO, the stock has always been relatively stable and the dividend grew by around 40%. Currently, they are paying a dividend of around 6%, but we have to take into account a potential boost in price following the Fed cutting the rates. Many real estate investment trusts have lost their, let's say, attractiveness because right now you can get like 5% from treasuries, so there is not much of a reason to risk it with a stock. However, once the rates get lower and treasuries pay close to nothing again, we can expect a nice boost for dividend stocks. Vici has some very high quality real estate, and something interesting that I saw, during the pandemic they collected 100% of the rent in cash and on time, so you can see that there is quite a bit of resilience. Something I really don't like about the company is the fact that two tenants bring in around 75% of the total rent, so if there is an issue with any of them, Vici can be in big trouble. You know, MPW, another REIT, got a lot of, let's say, heat for having around 20% of its rent coming from one tenant. Sure, healthcare is a very different environment than casinos right now, but it's a risk to keep in mind. I had a quick look at these companies, and from what I can see, MGM is fine, but Caesars has a lot of debt and has actually been losing quite a bit of money in the past years. If you're interested in Vici, you should definitely look very well into these two. They have triple net leases and inflation-linked rent escalators, which at least is a plus. Vici was founded as part of a bankruptcy reorganization of what was in 2017 Caesars, so there is a bit of history between the two. Before they had a merger with the REIT owning MGM's properties in 2022, Caesars was by far the number one tenant. The company has always been expanding, so this exposure should get lower and lower in time. Following the merger, they can now produce around 2.1 to 2.2 billion in AFFO, and they even increased the guidance for 2023. The debt is spread pretty much evenly throughout the decade, and with the exception of next year when they only have to pay 1 billion, they need around 1.5 to 2 billion per year. The issue is that they need around 430 million per quarter for the dividend, so let's say 1.7 billion per year. If they keep issuing shares and increasing the dividend, they might have a bit of an issue in a couple of years, but they have half a billion in cash and they can always issue more debt. Like with almost any real estate investment trust, it's pretty much in the nature of the business to issue shares if you want to grow. The number of shares increased by around 5% year over year, which is definitely something to be aware of. What I don't like about Vici has nothing to do with the financials though. The company itself is fine, but I don't invest in this kind of industry. To some degree, every penny that they pay is ultimately funded by people's addictions, and I simply don't want to make money from that. Although I doubt Nevada is ever going to do something like that, there is also a bit of political risk to keep in mind. Imagine if the federal government adds some limit to how much someone can gamble or make it illegal to sell alcohol in a casino, which blows my mind that it's allowed. Again, it's probably never going to happen, but if it does, it can ruin this industry, but the real estate can ultimately be used for other things as well. There is also potential from other industries and countries, however. They recently expanded into bowling and Canada, and you know, it's real estate, all you need is money. There is so much you can do and so many industries you can get into. As for evaluation, I think two scenarios are enough for Vici since there is a lot of stability, but you have to keep in mind the effects of them issuing shares and potential issues with Caesars. In a bad scenario, let's say they don't grow at all when adjusting for the number of new shares, so they would keep producing around 2.1 billion per year. If the market is trading them at 15 times that amount, that's a market cap of 31.5 billion and a stock price of around 30.5, so pretty much the same as today. So you basically get a 5.6% dividend plus whatever they increase it from this point. They should be able to pay the debt and keep increasing the dividend, but if there is any issue with Caesars, they will be in trouble and might have to issue a bit more debt. If this is the case, I think a treasury note would simply be better. But at the end of the day, we have to remember that Caesars is a tenant and Vici is the one that owns the properties, so they mostly lose rent if anything. That might be a very good time to buy because the market will not be rational about it. In a good scenario, let's say they grow at 8% but issue 3% in new shares per year. In half a decade in today's terms, that's an AFFO of around 2.725 billion. For a ratio of 20, which is pretty much in line with what we can expect from the market, that's a market cap of around 52.5 billion. Just so you know, I'm adjusting to the current number of shares so that we get a better picture. That would be a stock price of around 50.8, meaning a profit of around 65% plus, let's assume, another 35% from dividends, so pretty much a 2x. This is okay, but we have to keep in mind the potential for another big acquisition or the expansion in other countries or industries as they already do. So I would say that the current price is fine for me, but again, I'm not going to buy it. Overall, Vici is fine with the exception of their exposure to Caesars, the financials are good and the dividend is also nice. But at the end of the day, I prefer a realty income thanks to the higher yield and a much better portfolio of tenants, as well as the fact that I think that they have a much better potential to grow thanks to the recent expansion in Europe. Both of these companies and the stocks are going to benefit from lower interest rates, and I think this is an excellent moment to build my exposure to REITs. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.